So, Clorox just dropped their latest quarterly report, and yikes, sales plummeted. On the surface, it looks like a total disaster for this household giant. But, and this is the interesting part, the real story here is way more strategic than you might think. Okay, so the big number everyone's talking about is this one, a 19% drop in net sales compared to this time last year. Now, for a company like Clorox, a household name, a drop that big, that's the kind of thing that really gets investors' attention, and not in a good way. So right away, you've got to ask, is a giant like Clorox in real trouble, or is there something else going on under the hood? Let's dig in and peel back the layers of this report to figure out what's really behind that crazy number. All right, first things first, let's look at that sales slump. Before we even get to why it happened, you've got to appreciate just how big this drop really was. So here are the raw numbers. Sales went from over $1.7 billion down to just over $1.4 billion. That's a huge drop, over $330 million in just 1 year. I mean, no matter how you look at it, that's a massive number. But, and here's the twist, it turns out the reason for this nosedive isn't that people suddenly stopped buying Clorox wipes. Nope, it's because of a huge, totally planned internal project. The real culprit? It's a tech upgrade. And look, we don't even have to guess about this. The company spells it out right in their report. They say the drop was, and I'm quoting here, driven by an ERP transition. And that little phrase, incremental shipments, that's the key to this whole puzzle. Okay, so what on earth is an ERP system? Well, think of it as the digital brain of a massive company. It's the central nervous system that manages pretty much everything. We're talking accounting, shipping, project management, the whole shebang. And when you decide to do a full-blown upgrade on that brain, you try to do it without, shutting the whole company down. And this is where it gets really interesting. This whole tech upgrade basically created a sales mirage. See, Clorox knew this was coming. So to keep shelves stocked, they just shipped a ton of product out to retailers before the quarter even began. The sales didn't just vanish. They were pulled forward into the last quarter. It's kind of like a restaurant closing for renovations. The day before they close, they might sell off all their food cheap. So sales look weird, but it doesn't mean they're going out of business. But wait, there's actually another layer to this. It turns out that the year they're comparing these numbers to, well, that year was a little weird too. Right, so to get a real picture of what's happening now, you have to filter out all the noise from last year's numbers. For a fair comparison, you need a clean starting point, and last year was anything but. There were two big things that skewed last year's results. First off, they booked a huge loss. We're talking $118 million from selling off a part of their business. Then they got a $9 million check from their insurance company for a cyber attack that happened earlier. Since neither of those one-off things happened this quarter, comparing the two is like comparing apples to, well, apples with a bunch of weird stuff happening to them. So what's a divestiture? It's really simple. It's just when a company sells off a piece of itself. In this case, Clorox got rid of its vitamin and supplement business, and that created this big one-time loss on their books last year that obviously isn't there this year. All right, finally, let's talk about something that's buried deep in the report. It's this huge event on the horizon that tells us a lot about the company's long-term game plan, and it has nothing to do with that sales slump, but everything to do with where Clorox is heading. And it's all about one of their most famous brands, Glad. Now, here's a fun fact you might not know. For decades, the Glad business has actually been a joint venture, a partnership between Clorox and another huge company, Procter & Gamble. Well, that partnership is about to end. The agreement is up, and it looks like it's not getting renewed. This triggers a clause in their contract, a mandatory buyout. Basically, Clorox has to buy out P&G's share. It's not optional. It's written right into the contract. And here's the bottom line on that. Clorox is about to write a check for almost $500 million. Yeah, you heard that right. It's a huge chunk of change, but it means they'll finally have 100% ownership of the Glad business. It's a big strategic move to bring one of their star players completely in-house. Okay, so we've peeled back all these different layers. The ERP system, the weird data from last year, this huge Glad buyout. So what does it all mean? What's the real story here? Well, here's the breakdown. First, and this is a big one, that headline number almost never tells you the full story. That scary 19% sales drop, It wasn't a crisis. It was a planned, predictable blip from a major tech upgrade. And finally, you have to look at the context. This report really shows a company that's making moves for the long haul, investing in its internal systems and taking full control of its biggest brands, even if it makes the short-term numbers look a little messy. Which leaves us with one last question to chew on. Clorox is clearly tidying up its own house, right? They're modernizing their operations, they're taking full ownership of Glad. But now that we know the real story, the big question is, will all this spring cleaning lead to a cleaner bill of health for the company and, more importantly, for its investors? I guess we'll have to wait and see.